Hello everyone. In this video, we are going to be looking at why investors primarily use interest-only mortgages. Now, obviously, there's a lot to cover, and there are a lot of nuances in any sort of financing arrangement. We are going to be talking about the difference between interest-only and capital repayment mortgages. We're not going to be talking about things like mezzanine finance and bridging and all the other different elements that's covered elsewhere. But this is just why do we utilize heavily, particularly in the building phase of our wealth creation, why do we use interest-only mortgages and as opposed to capital repayment mortgages? So let's jump in. Now, one of the things we're going to do is we're going to talk through an example. These are the numbers we are going to use as we go through this example. We're going to be talking about a mortgage of £100,000. It just makes the maths easy for me. We're going to be talking about a purchase, which obviously equates to a purchase of £133,000, and we're going to use an interest rate of 5%, which is roughly where the market is at the moment. Now, we're going to use a 20-year term. Obviously, you get shorter terms, you get longer terms, but that is the bulk of mortgages in and products in the mortgage market are around a 20-year term. Okay, so for anyone that's detailed, those are round numbers. I'm going to round up numbers because the concept here is more important than having this granular detail. Obviously, when it comes to actually implementing a deal, you would want to have that granular detail. And finally, this is obviously not personal financial advice. This is very generic concept stuff. So with those numbers in mind, let's talk through what the actual difference is between a capital repayment mortgage and an interest-only mortgage. So a capital repayment mortgage and an interest-only mortgage, for once, the financial sector have made these terms quite clear as to what they represent, and they haven't made the financial sector is deliberately opaque in a lot of their language, but in this case, they've actually stated exactly what the product does. So a capital repayment mortgage means that on our mortgage of £100,000, as we're using this in example, over 20 years, every month you will make a payment towards your mortgage, and a proportion of that payment some will be interest and some will be towards the actual capital, so paying off that £100,000. Now, what that means is in 20 years, when you make your final payment, you are looking at being debt-free. You do not owe a penny on that property. You have paid back the bank everything that you owe them, and you are now the proud owner of said property. Whereas with an interest-only mortgage, you're only paying the interest element every single month. Now, you may think, well, but hang on, I want to be debt-free. Popular financial advice is, I want to be debt-free. That's what I want. And yes, the answer is yes. It's how we get there. And my personal opinion is that this is probably the most expensive or least effective way of getting to being debt-free when it comes to property investing. Okay, but now that we understand the difference, let's jump into why we utilize this. And I just want to make a quick point. When we are talking through the differences between these two mortgage types and the strategy through the rest of this presentation, it's ideally suited to somebody who is looking to build a portfolio, a reasonable small to medium-sized portfolio, sort of 5+ properties. However, it can work with just one property. There is a methodology where you could utilize the same strategy with just one property. Okay, so let's get right back into it. Why do we use interest-only mortgages if this means that in 20 years we are still going to owe the bank £100,000? Why on earth would we do that? Well, first thing is cash flow. Cash flow is king. There are hundreds, tens of thousands of examples of companies and individuals who have gone under, not because they don't have a good asset base, not because they don't have a good balance sheet, but because they literally do not have the right cash flow. They need money at the end of the month and it just is not there. Okay, it's a very, very common cause of failure across the board, in different sectors, in major corporations, on an individual level, and everything in between. So because we are only paying the interest proportion, our physical monthly payment is less every month. Now, on our £100,000 mortgage, on our £133,000 purchase, at a rate of 5%, I did a bit of the maths, and effectively we are paying £243 less per month, which may not sound earth-shattering, but in the course of a year, that's just short of £3,000, so we call it £3,000. Over the course of 20 years, it's a difference of £60,000, okay? Rounded numbers. I think it's about 58,300 odd pounds, the difference between those two payment types, okay? But every single month is a difference of about £240. Now, that will cover probably, some of your utilities, your council tax, depending on where you live in the country. That makes a material difference. Now, we'll always talk about making sure you approach any financial transaction in a financially responsible way. We are not saying utilize these funds for, what's the right word? Nonsense and junk. We are saying utilize it in a financially responsible way. So that doesn't mean going and buying the nice cars. As I said, we're talking about building a portfolio here. So on a portfolio of 10 properties, that's a difference of £2,500 per month. All right. So it starts to become materially different, once we start to expand that portfolio and build that volume. Now, the other major item, so that cash flow is the short-term gain. That's the monthly gain. That's why we use interest only. The long-term gain is to let the inflation and equity growth do the heavy lifting. Now, our property, we purchased it, if you remember, for £133,000. That property in the UK doubles in value roughly every 7 to 10 years. That's a very broad figure. It depends where you are in the country. In some areas, that's going to be a lot lower. In some areas, that's going to be a lot higher. Okay? But as a broad rule of thumb, we're going to look at doubling the value of that property every 7 to 10 years. Therefore, our £133,000 property in 20 years will theoretically be worth 133,000 doubled in 10 years is 266,000, doubled in another 10 years is 532,000. Okay, I hope my maths is right there. But we are looking at a £500,000 property with a £100,000 mortgage against that. So now you have options. Now, let's say you have gone, or let's say you've just done one. You could then sell that property, realize the capital gain. Obviously, yes, there's taxes to pay, but realize that capital gain. Now, all of a sudden, you've got a pot. So you've gained the cash flow. You've had the cash flow for 20 years, and now you have a pot of several £100,000 that you could then utilize for whatever else. But let's say you've gone out and built a portfolio of, say, 5 to 10 properties. Now, for example, purposes of example, let's say all of those properties were exactly the same. You could sell property number one. You've got, each one's got a mortgage of £100,000. And let's say you come out of the transaction with a £400,000 profit. You could then pay off 4 of your other properties because you've bought 10. They're all exactly the same. They have the same value. They have the same mortgage against it. You could then utilize those funds from the property which has had the longest capital growth to pay off the mortgages on some of the others, okay? And what that would mean across sort of 10 properties is you're probably likely to sell 2 or 3 and end up owning the other 7 outright anyway. So you are still debt-free. Another factor to consider is when you start your journey in property. Now, because it's been 20 years, let's say you started at age 25 to 30, which is where we find a lot of our clients, probably in their 30s, start to look at property. What that means is you will be in your roughly early to mid 50s. You could then utilize, just go again. Because what bank, on day one, they needed security of 25%. In other words, the mortgage was 75%, and their security was the 25% deposit which you put into the property. Okay? So their security is only 25%, sorry. In 20 years, that is halved and halved again because of the value of the property. So the value of the property has gone up, the value of the debt has stayed the same, therefore their security has increased. If they ever had to call in that loan, it's going to be easier to sell a property that's worth £400,000 and try and get 100,000 out versus on day one sell a property that's worth £133,000 to try and get £100,000 out. Now, I hope you're following me. Obviously, feel free to stop, pause, rewind, listen again, and drop any questions, comments in the comment section, and we will come back to you if there is any confusion. However, so the point is, when you started this journey does make a difference. If you structured it correctly, it doesn't make a difference, because if you structured this correctly in terms of property, a company, then the onus is on the company, not you as an individual. So you could, but the principle stays the same. You could just refinance onto a different product for another 20 years and just let the equity growth do its thing again. So we've got the first example, which is we sell some of the properties to pay off the debts on the others. The second example is we could then just go and put a second product in place, which allows us to just further let the equity growth and the inflation erode the value of that debt, as well as the equity growth growing the value of the property. So those are the two major reasons. Okay, number one, short-term cash flow. Number two, inflation and equity growth allowing you to erode the value of your debt. Now, there is a slightly more technical element that you'd want to consider here, which is, if you are paying off the debt, you are paying it off, in our example, at 5% per annum. Okay? When we go out and we look at deals, we are looking for a return on investment or return on capital, same number, of around 15 to 20% minimum, which means by not deploying that capital elsewhere, you are potentially losing out on that 10% margin. And what I mean by that is, if you're paying off your debt at 5%, but you could take that same money, still have to pay the debt at 5%, but earn 15%, that gap between 5 and 15% is your money. That would be profit that you would be making. Okay? So simply put, if you had, say, £3,000 that you hadn't paid off to the bank, that was now sitting in your business, sitting against that property's balance sheet, you could potentially utilize it in property number two for part of the refurb cost, and so on and so forth. So that means you're not finding that money elsewhere. You are starting to utilize your money, and your ultimate scenario is you're making money on money. Really, that's really what we're doing. Property is just the mechanism of how we do that. But the point is, we are utilizing those funds, that excess capital, to gain us more funds if we allow it to. Okay, so I hope that makes sense. And as I say, drop any questions and we'll make sure we get through to it. So those are the two main reasons. And obviously that third reason, utilizing our money to grow further, are the main reasons we look at interest only. And you always have to be looking at exit. You always have to be looking at, how am I going to pay this off? What is my exit going to be? And that will change. And that's where, you make sure you have the guidance, where you make sure you have the relative information and knowledge to be able to utilize these strategies to your benefit, because they will change over time as well. That's the important thing. Day one is not going to be the same as year 10. Your life changes, your perception changes, your risk profile might change. So I hope that's given you a good overview of why we utilize interest-only mortgages. And a final word would just be, the main thing is to just get going in property. You can watch videos, you can sit and strategize, you can get on a spreadsheet, you can look at Rightmove or Zoopla, you can do all of these things, but it's the knowledge, having a strategy or a plan, whichever word you want to use, taking the action will equate to a whole new world for you. And property is one of the vehicles we certainly would recommend to doing that. I hope you found that useful and insightful. Any questions, please do drop them in the comments and we will come back to you. Thank you so much.